What's up, Outliers? Welcome back to the Thunderdome. Thanks for hanging out for a couple minutes. And we are ready to rock and roll. Yesterday, we talked a bit about a process that we can use to figure out if we want to use options to get long or short something. And we used an example on the long side. We used, I want to say it was ASTS if I remember. And we just walk through a series of questions that we can ask ourselves effectively to help us figure out what options allow us to express our idea the best or optimally. What I want to do today is build on what we talked about yesterday, and I literally just want to flip the script. I want to talk about two things. I want to talk about long versus short premium first. Then I want to talk about long versus short direction. This is, again, a similar concept, and I admittedly do not have a framework yet. I'm hopeful that we can effectively create one together. It's because there isn't like a checklist that I personally follow. I've been doing this a long time. And I'm not saying that that justifies the scenario. That's just the reality of it. Because I've been doing this a long time, I kind of have an innate process on how I figure out long versus short options, long versus short premium, long versus short direction. Like all of that is kind of baked into the way that I think about the world. So I want to start with a couple things to get us on the correct page. Let me grab something with a little bit more space so I can really explore this space and, draw. I got to really express myself here. Find an empty area. Here we go. Oh, this is actually perfect because this is here. Good. Good. We're probably going to reference that at some point, I imagine. Okay. The main thing we talked about yesterday, to summarize it briefly, is that when you're deciding what option you want to pick, how to use an option to get long or short something, it should be a process. It should not be some sort of novel decision that you're making each time, net new. Even if, and this is the ideal scenario, by the way, the ideal scenario is literally to do this kind of process and to have a strategy outline. In the strategy outline, we want to have, at least I have, some parameters for each strategy that I trade and some of the details that are relevant to it. Yesterday, we were looking at a breakout. So let's just continue on that thread. In the breakout strategy, we have a very clear profit mechanism. In that example, I'll stop saying we because I'm very used to like a team environment and not saying me. The military will do that to you, but I do not want to impart this on you if it doesn't apply to you. So what I do for a strategy outline is I'll list what the profit mechanism is. So for this breakout strategy outline, the profit mechanism that I'm specifically trying to capture is some sort of price direction. So typically price direction up. And there's very specific qualities of this. So there's typically velocity. That means severity. How much does it move? And then quick duration, where the move is expected with the potential for continuation. Into momentum of some sort, and so on. I'm not going to go through a strategy outline here. I just want to give you some inspiration to think of as I go through the rest and how I'm thinking about this. So how do I then figure out what strategy, or specifically to start, what structure makes sense? Well, that's your job as a trader to test it. So when I'm figuring out what my typical strategy is going to be, I might start with basics. I might say, well, I can buy a call. I can sell a put. I can sell a put spread. I can buy a call spread. I could do some sort of hybrids of just buying equity, synthetic longs. I could do, there's a couple other things that I'm not really sure people would immediately gravitate towards, but you could do something like a calendar, diagonal, essentially going horizontal. So my job as a trader is to outline what it is that I'm trying to capture. Once I understand what this thing looks like, what the qualities are, what the traits are, I'm going to measure all of these things. I'm going to say, well, what's the average duration? Let's say that the average duration for a breakout move is 6 trading days. And over those 6 trading days, on average, there's a standard deviation, +1 standard deviation down to like 1 day up to 12 days. What this immediately tells me is, on average, based on the things that I analyzed, it typically takes about 6 trading days for the move to occur. On the short end, sticking within 1 standard deviation of occurrences, it's a day. On the long end, within 1 standard deviation, it's 12 days. This gives me really important information because if you remember, based on the process we talked about yesterday, one of the things that we have to ask ourselves when we're figuring out what option we want to get or sell, we need a duration. We need to know how long we're going to be doing this thing for. This is giving me that. Velocity gives me some sort of expectation of move. How much does this thing move on average? What's the distribution of the moves? Based on that, now I have some sort of price/profit target. I have an idea of where I think the underlying might go. Then I might have secondary conditions like if certain other things happen, then there's a XX% chance that it will result in continued drift via momentum. So it all becomes a probabilistic assessment based on what I've studied. The reason why studying the profit mechanism like this is so important is because once I know these details, the work is effectively done. Literally, the entire project is super, super fucking simple. If I have an idea of how much the thing is going to move, I'm going to know if I want capped or uncapped profit right away. If I know the durations of this thing and I have an expectation of duration, I now know what DTE I'm going to pick. Based on the size of the move and the duration combined, I now have some ideas in terms of what delta for an option would make the most sense. So the way that I bring all this stuff together is by testing all of these different permutations first, agnostically. So it means I'm not really going to care if I buy a call, if I get some sort of synthetic long. I'm just going to look at them all. I'm going to see how they do in this general condition. Once I go through that process, more often than not, for a strategy in this specific example, I don't have only one structure that I will use because it's context dependent. We already went over some of these hard questions. When I say hard, I don't mean difficult, but I mean like they're steadfast. They have to be there. There are some hard questions like liquidity, like volatility, portfolio fit. These things factor on top of whatever's optimal. So for this breakout approach, maybe the list of suitable structures is stuff like long calls and then given a window. So let's say anything from 7 to 90 days, whatever. Then maybe there's synthetic long, given another window. What I'm doing is I'm looking at the output of me testing all of those different structures in the context of this profit mechanism and I'm reviewing the performance of them. And I'm saying, okay, this one did well based on what I expected to see. This one did bad. This one did bad. This one did well. This one might have lost a lot of money periodically, but it also makes an absolute ton of money if it's done correctly. So this one's good, but there's more criteria that needs to be built around that, and so on. Okay. So then we have our first question. We did our analysis, we did our scan just like yesterday, and we arrive at the point that we want to be long or short something. And we already talked about the different questions and stuff, so we'll literally just roll through it in practice. One of the easiest starting questions, this is, by the way, direction, not buying or selling options. One of the easiest starting points to consider here is, again, looking at the profit mechanism. Based on that profit mechanism, it's typically going to have a preference for defined or undefined risk and reward. Based on what you typically run, there are going to be certain things that are going to have a natural tendency. Another great example for this is zero DTE strategies that I trade. There are some really, really effective periods to be long volatility on zero DTEs. In general, that's not good. In general, being on the short side does a little bit better. What I'm saying here is I know based on that profit mechanism for zero DTEs, in general, I'm better off being short volatility versus long. Not always. So when I'm trading zero DTEs, I have a couple different structures listed based on set criteria that I've tested. What I'm highlighting here is when you're analyzing something for a trade, the point to start deciding like what structure, what strategy makes sense is not during that individual trade. You should already have an idea based on some sort of historical analysis you've done. And again, a reminder, you don't have to do some sort of crazy back testing regimen, which would be better. If you're going to do this at a high capacity, you should do that. But you can also paper trade stuff for a while. If you paper trade stuff for a year, you're going to have some pretty fucking good data. It's still going to have a ton of limitations, but you're going to have some really, really good ideas based on what you've done. And that will help you tremendously when it comes to making these kinds of decisions. The main thing to take away here is that deciding if I'm going to be long or short premium happens way before. But I'm going to define that at the profit mechanism level. Now, like I said, with zero DTEs, there are instances based on how the market rolls out where for zero DTEs as a broad profit mechanism, there are conditions that I would want to be long premium and short premium, respectively. So then I need to have specific playbooks for each of those. If you're going through this testing process and you're trying to figure out the first question, let's say that you have a profit mechanism defined and you're going through the first question of testing long versus short premium. We know some very specific things based on our general understanding of options. We know that if we're long premium, typically speaking, we're going to see undefined profit and defined risk. We also know that we're going to experience theta decay, typically going to be long gamma. We also know that we're going to have stuff like charm decay that can negatively impact us and so on. And then essentially the inverse for short. One of the things that people mistakenly assign to these is a probability. People will say that this long option has a lower probability of making money than the short option. Who could take a guess why I would say that's incorrect? Why would I push back on that idea? In a raw academic sense, I would absolutely concede that point. But again, in practical application, it's not academic, it's practical application. And there's a very specific reason why I would push back on that. I gotta open my window real quick. Kirk says, what's the question? The question here is, a lot of times people would say that long options have lower inherent probability than short options, right? It's typically a primary reason to sell. But I would argue that that's not actually like a good lens to overlay. So my question is, why would I argue that point? Why would I say that I don't think that that is a good lens to overlay when you're comparing these two? Reese says not holding to expiry. That's actually a big one. That's a really big one. That's absolutely part of it. If we look at buying this call that's 34 days and we plot it based on current prices, exactly to Reese's point, if we don't hold this to expiration, and let's say that the underlying ticks up a little bit, let's say that the underlying goes to 695.61. If it goes to 695.61, we're making $232 today. But if we held that position at expiration, we're losing money. We're losing $861. So what Reese is talking about is exactly correct. It's the fact that since we are not holding to expiration, that actually has a big impact on the analysis. So that's definitely part of it. What else do you guys think? Kirk says probability is an expected return. That's correct. I'm speaking specifically about probability here, but that's absolutely correct. Deconstruct what you said, though. What is a baked-in element to probability? Because that's the point that I want to highlight. What's the baked-in element to expected return, Because that is part of our answer here. User says most people go long when there's hype and premiums are already very expensive, so break-even price is very high. It could be. But again, just because price is very high doesn't actually really mean anything. Unless you're a value investor, then obviously you would want to avoid that. But if you're not a value investor and you just want to get something that does what you need it to do, even if you get something that's expensive, as long as it goes up, it doesn't matter. You still made money. Now, it's difficult to make a long-term profitable book if you're constantly swimming upstream. But the specific point here is that if somebody said to me, long options are lower probability than short options, the main point that I would push back on is that all depends on you and your entries. No matter what. Let's say that I'm a directional trader, and let's say that my strategy, I buy options. Let's say when I buy options, I have a really high probability of winning. Even though that out of the money call that's at a 30 delta and has a lower probability of being in the money at expiration, if I overlay my analysis and my analysis is good and I have a high probability approach, then I can actually have a completely fine probability with long options. The problem is people argue the theoretical element of if you buy an out of the money option, that absolutely theoretically will have a lower probability of making money than a short out of the money option comparatively. But that's not exactly how markets work. Because if I have some sort of technical setup that I use that works really, really well, then it doesn't matter. The trade still makes money. So the key element here is the probability element of options comes down to the strategy. Don't worry so much about the baked in probabilities of what they are, because it actually might not be super relevant to you. That doesn't mean don't consider the probabilities. You should do that. It's good to do. But what's more important is whatever your strategy is and whatever the analysis that you do part of your setup. Because even if you buy a super far out of the money option, but let's say that you're really good at picking direction, whatever your system is, even though that super far out of the money option is a super low probability of being in the money at expiration and making money, you can still make a lot of money. That's the point. Long versus short premium should be determined based on the qualities of long versus short premium when you practically apply them. And a great example of that is defined versus undefined profit, for sure, because that's a big part of the equation. Now, comparatively against something other than a breakout, let's say that I was trading something that I was kind of expecting to go sideways, not necessarily break out to the upside, but just oscillate sideways. And let's say that I was moderately bullish. Well, that's a great example of something that I do not want to buy calls in, because one of the things I do know if I buy calls is not only do I need it to go in my favor, but I need it to go in my favor quickly enough to overwhelm the traits of a long call. This is why when I talk about some of my directional strategies where I'm long options, I actually have lower win rates. And it's because I build those very specifically that I'm either going to be wrong very quickly and I will be wrong, or I'm going to be right and I'm going to be right very quickly and have an asymmetric return. That's exactly what it is. And a good example of that is here. In Rocket Lab, and as I started to phase in on another breakout, it was either going to go the correct direction right out of the gate, or I was going to be wrong. And if I was wrong, I want to be wrong fast. And then I want to get out and potentially re-enter if I need to. But what I don't want to do is get long Rocket Lab here, hold it through this, and then this if it's a shorter term breakout play. If it's a different profit mechanism, that's no problem. But for that specific profit mechanism, this could kill the trade, because this downside path based on the options that are selected, if it's a shorter term breakout play, right, where I said averages 6 days up to 12 for one standard deviation, if we look at the duration here, that's 4 days, that's 8 days to here, 9 days to break even. So if this was a 30-day data expiration trade, half of it almost is eaten up, not quite a third, but a good bit of it, well, a little bit more because these are trading days, not calendar days. Quarter to half is, or a third and a half is eaten up in here. So then if this move starts to happen, unless it's aggressive enough, it might not actually be super profitable. A good example of that is the breakout that I did in ONDS. This was a recent breakout. I played it right here. It broke out. It rallied here, tried to press up, got shut down. Then it opened here, tried to press up, got shut down. Boom, I'm out as soon as it starts going below here. And it's because I'm not going to hold this thing based on this specific profit mechanism until it's doing what it needs to do. And if it starts going back up as aggressively as I think it should, then I get right back in. I don't care about bouncing in and out. But for that specific profit mechanism, it requires me being active like that. And because I'm active like that, I can have at times a really low win rate. I've had win rates in the low 40%. But exactly as Kirk was talking about before, there's a massive difference between win rate and profitability. And I care way more about profitability. That said, some traders struggle with being wrong. And I'm not here to say one way or the other. If you are the kind of human being that struggles with being wrong and you can identify that, there is a reality that if you can't maturely address it and navigate through it, which would be my preferred approach, but if it, for whatever reason, can't be done or struggle to do that, it might mean that low win rate strategies just don't work that well for you because you have to accept this. And if you struggle accepting being wrong frequently, then that can absolutely crush whatever your strategy is, whatever your expected deployment is going to be, because that's the human condition of trading that you have to manage. All right. We talked a little bit now about long versus short premium, which is pretty easy. I now want to talk a little bit about when we decide that we want to get long in terms of direction or short in terms of direction, what this looks like in a practical sense. So user earlier said, looking at software companies like CRM or ADB, which have declined recently, what short premium option selling is best? Cash secured put or bear call spread, or is there any better strategy? It's a great question. Now, the first thing that I would tell you, senor or senorita user, is that it depends on what you think is going to happen. So let's take a quick peep. We'll do CRM because that's the first one. CRM has gone down a lot. The first question that we need to say to ourselves is, what do I think is going to happen? If we're deciding between, let's say, a cash secured put or a bear call spread, think of those two trades, right? A cash secured put is bullish. We want the underlying to go up. A bear call spread or short call spread is we want the thing to go down. So we can use the base behavior of those structures and make sure it's aligned with what we think the thing is going to do. So user says, I think they're going to struggle for a while. Okay. So if something is going to struggle for a while, that's one thing, but let's be a little bit more specific. Do you think that there's more downside in store? Or do you think that the downside is about done and it might struggle by just oscillating sideways for a while? Why does that matter? Well, because right now, if something goes down like this, we should know that put skew is actually going to be higher because a lot of people are wanting to buy puts right now because the thing's fallen off the face of the fucking earth. If we had an assumption that we think for whatever reason that most of the down move is done and we think that it's going to oscillate sideways, then actually selling puts can make sense. But notice how I said selling puts, not cash secured puts, because a big part of cash secured puts is being willing to take assignment. So unless there's another really important part of this hypothesis, which is this overall behavior is very temporary, and we're super bullish on it going forward, and we want to accumulate it down here for a longer term investment, well, then a cash secured put can be completely appropriate. But if that's not the case, and we don't want to hold the inventory, then it's a great example where a cash secured put would be completely unacceptable. And that's the interesting part about options in trading options. We literally just talked about the same general strategy, yet I gave you two different conditions in the same underlying where doing the opposite trade can make sense. And this is why defining very clearly what we think is going to happen is super important. Let's say we think that there's likely to be a floor here. Let's say that we think the floor is at 225, the general levels here. And we think that it might trace down to 225 based on this. It's been down about these levels back here, and it's been hovering sideways for some time now, effectively from April. we decide that we think that there's a floor in here. That's okay. We can make that guess. If we make that guess that there's a floor in here, now the first admin note for me personally, the way that I would trade this is I would wait and see what it does when it gets closer to this 225 handle. Do I think, based on the way it's trading around that 225 handle, that it's going to linger there, or does it just careen right through it? So I would wait to do any sort of bullish trading approach in here until there's some kind of confirmation based on how it moves. The other thing we could do is look at the options market itself and see what the options market is pricing in. What I want to do is I want to look at the shape of the curve, and I want to see how delta is behaving. And I don't know why these aren't loading. That's really super annoying. Let's see. Okay, these look fine. So we'll use this one. If I look at the shape here, the 230s are the 50 delta. Then if I go one strike up and down, I see a 43 delta and a 42 delta. About fine. I go another strike up and down, I see a 36 delta and a 37 delta. I'm already picking up on a trend. The market is at least right about the money, pricing in a slightly higher probability of down ticking to here. But then as soon as you get a little further out, the market is actually favoring not going down as far. And I'll show you what I mean by that. This is literally using options markets to help amplify our assumption. I'll move this and I'll show you what I mean. So the at the money is the 230. This plus 5. This minus 5. And we're not going to go super far. We'll just go a few strikes because we don't actually have to go that far. What did I do? I did 4, 5. I'll do 5. $30. Need one more. 225 is the... Oh, wait, hold on. I fucked up. Oh, no, the 230 is the at the money. Okay. 230 is at the money. 5 to the upside. And 5 to the downside. Now I'm going to plot the delta. So the 230 is a 0.51. And I'm going to use the out of the money option. So it's a 0.5. Then the 235 is a 0.42. 240 is a 0.37. 245 is a 0.31. And then a 0.28. And then a 0.22. Then the other direction, we got a 0.43, 0.36, 0.3, 0.24, 0.19. All right. Now, if I plot this, you'll see what's going on here. You literally can take a look at the shape of the distribution, what the market expects to occur. Notice how the steepness is actually a little aggressive to the upside, but then it flattens out, especially as you're going down. So what's happening here is that the relative slope between these strikes is slowing down. That tells you how the market is gauging this move. So if we start with the at the money and we look at the deltas and the difference between these deltas, let's add another decimal. Oops, didn't mean that one. Let's do this one. Notice the slope. The slope is much steeper to the put side. much steeper to the put side. The reason why that matters is because this is the market saying the expected distribution of future returns. It's a little bit of a side quest, but it's a really nifty way to use options to have a better idea of what the market is pricing in terms of the difference between these. What's the expectation? Hold on. This one should be, yep, that's good. It's lagged by 1, but I don't actually care that much. Yeah, that's better. So the slope and the shape of the slope tells you a lot. It tells you a whole lot. As we know, delta, as it gets lower and lower, that's the market effectively saying, I don't think it's going to go here. So we can see that there's a 10 delta at 195. And then the 10 delta is at like the 272.5. What's the difference between these? Spot is at 227. To the upside, it's expecting 272.5 is like an extreme. And then to the downside, it was what? 195 is where it's expecting. How far off of these? Downside is 32 points. Upside is 45 points. Same delta. This one's literally 13.5 points further. So the market is starting to price in a floor. That's what this is. The market starts to say, well, I think it's super improbable to be down here. So when trading something like this, you can use that as a secondary factor. Again, that's definitely not how I would trade this at all. I wouldn't trade this to the upside until it consolidates for a little bit. But if we wanted to trade this via short puts because we think the vol might be high, well, that's not a terrible idea. If we look at CRM and we eyeball what the vol is, let's say like 30-day vol, in terms of a percentile, it's at 48%. So it's actually not as high as I would expect it to be. This thing clearly has gone through some trying times if the vol isn't higher based on these moves. It also has earnings coming up. So pretend that there isn't earnings. And then if you look at the vol here, you might actually say, shit, that actually is not as much as I thought I would see. One, I don't want to catch a falling knife and sell a put, which is bullish when the thing is going down. Two, vol isn't quite that high. But again, remember, you're not trading directly mean reversion of volatility with short options unless you're isolating vol. Instead, we need to take a look at what risk premiums are. Right now, we can see that realized vol is actually trending over implied. So then we might actually expect that to reverse again, or we might expect this to cluster. But the one thing I can tell you is that the risk premium and the risk premium percentile is super low right now. So for all of that stuff, I actually wouldn't like it. And again, this is a way to look at something and just use our understanding of options to figure out what we might want to do. So given the choices offered in the beginning, a short call spread or a short put, I would much prefer the short call spread here. And it's literally matching what the underlying is doing to my expectation and then analyzing the residual details and making sure that what I end up putting on most accurately reflects my expectation. Any questions on that process and any questions on what we discussed with respect to making a determination if we want to buy or sell premium and if we want to get long or short an option? Your key takeaways is that most of the work should be done via testing. back testing, live testing, paper trading, forward testing, whatever variations you prefer. That's the only way you're actually going to get good, broad levels of objective data to make decisions. If you don't have the proclivity to start there, one, we have to acknowledge that that is a pretty big gap. But two, we can start more simply by paper trading live markets. The downside to that is your sample is going to be small, but it's way better than nothing. User says, would you ever go long with this low vol and seeing a floor with analyzing skew as you did with CRM? Would you ever go long with this low vol? Well, vol isn't that low. That's the thing. It's like right in the middle, right? If we look at the volatility percentile for these different time frames, like volatility definitely is not low. 30-day vol's at 48%. So it's like right in the middle of what vol tends to be. 60-day is actually a little bit high at 64%. Between both of those, I wouldn't consider volatility low here at all. But more specifically, if I saw some sort of floor and I wanted to play around the floor, I, again, would still wait until I saw price get close to that floor and I could see how it behaved there. Because just because I think there might be a floor there doesn't mean that there is, and it doesn't mean that the market gives a shit. And because of that, I want to see how the market reacts. That's my hypothesis, is that there might be a floor there. There's very little for me to gain by getting into the trade before it interacts with the spot that I think it's going to be. There's a little bit to gain by front running, by being correct earlier, but the probability of being correct is typically much lower. So I prefer to wait for some sort of confirmation before I enter most things. And that's based on, again, the way that I operate and the profit mechanisms that I typically focus on. Kirk says, if you get a bad fill, are you overpaying for Vega, or what are you overpaying for to cause the premium to be higher? I guess I'm asking if what you pay changes the Greeks. Definitely. What you pay, right, absolutely will affect the Greeks and your effective Greeks based on your price. Typically speaking, it's going to come through volatility because all of the other inputs into an options price are knowns. Days to expiration, that's standardized. Distance or delta, distance from the money, that's standardized. What the interest rate is, what the risk-free rate is, that's standardized. If there's a yield for the underlying, that's standardized, right? So all of the main things that we use to price an option is standardized. The only thing that isn't is implied volatility. So if you overpay for an option, whether it's from a wide bid-ask spread or whatever, if you pay more than something close to the theoretical value, it just means that your effective implied volatility for your option is higher. And you can compute what the IV for your option is, what your IV is, which is pretty easy. All you do is use the Black-Scholes-Merton model, plug in all of the current pricing data based on the underlying stats and your basis, and then it'll tell you what the implied volatility was that you bought. That's effectively what you overpay for. Sweet. All right, gang. That's all I got for tonight. If you guys need anything, you can hit me up in the Discord, be an outlier. I'll see you guys later.